Good morning. It's Jeff Christian of CPM Group. It's about 10:15 in New York on March 10th. I wanted to talk today about capitalizing on a gold and silver price spike. The subtitle there is "What if CPM is right?" When I was a kid, I had a dog named Chaucer. Chaucer was always chasing squirrels. One day he caught one. And the look on his face as he realized that he had no idea what to do with it was hilarious. And I think about this because so many investors are buying gold and silver for good reasons and for bad reasons, expecting prices to rise sharply. Some investors look at the world and they say, it's a good time to be increasing my gold and silver holdings. Percentage of my wealth, percentage of my portfolio in gold. Other people have all kinds of crazy things about the idea that the world's going to collapse or civil war is going to break out and gold's going to go high and stay high. Investors, generally speaking, often aren't prepared to take profits and capitalize on spikes in gold and silver prices. We've had clients who have done that very well, and we have had people that we have advised, warned that the prices were going to spike higher and that they should take profits when they do, and they don't. So I wanted to talk about that today. I'll throw in a couple anecdotes here. First, let's talk about the nature of gold and silver and, in fact, other markets. They rise and they fall. And then we'll talk about what an investor can and should do about it. This is the price of gold since 1968. You can see a spike in 73, 74, a spike in 78, 79, smaller spikes in second half of 1982, 1982, then again 1985 to 1987, and then the big one from 2000, 2001 up to 2011, came down, and we're in another spike now. Those of you who listen to us know that CPM Group expects the price to be relatively flat this year, trading between, say, $1,750 and $1,980. We're looking for the annual average gold price, which was a record $1,804 last year in 2022. We're looking for a new record of about 1860 or so, I believe, this year. And then we're looking for a spike much higher at some point in 2024, 2026, or at some point in the future. We've put those dates on our calendar as we think it's the most likely window for a combination of economic, political, and financial issues to come together and cause investors to race into gold and silver and drive the prices sharply higher. We could be off on timing, but when you look at the economic environment, the financial markets globally, and the deteriorating political environments, both domestically in many countries around the world and globally, it's a pretty good chance that you're going to see all of those factors come together at some point over the next 3-4 years and scare a lot of investors into gold and silver, at least for a brief period of time. But the key here is that history tells you gold prices spike and then they fall back. They rarely go back to their previous levels. They make a new base at a higher level, but they fall back. And I think that's very important to understand. Silver, very similar. 1979, 1980. This only goes back to 75. I apologize. There was a spike in silver prices earlier as the U.S. Treasury got out of the using silver coins in the 1960s and having silver-backed certificates. 1978, 79, and a lot of people blame that on the hunt. But if you look at it, gold prices also spiked and the hunts weren't there. Oil prices quadrupled and the hunts weren't there. And copper prices, wheat prices, and a number of other things spiked. You had very high inflation. Saw another spike in late 82, 83. You saw a smaller spike in 87, and then bigger ones in the Audis, really starting around 2005 and culminating in 2011. And we saw another spike 2020 into 2021, and we've come off. Now, the important thing here is tigers don't change their stripes. Gold and silver prices have the capacity to spike to sharply higher prices, and the economics of gold and silver supply, mine production, secondary recovery, fabrication demand, and investment demand are such that they will keep prices from staying at those high levels. And it's happened over and over again. History shows you that gold and silver prices spike higher at times of economic and political stress, but history also shows you that the prices fall back sharply after such spikes, although typically not back to previously low levels. So assume that the economic realities of gold and silver remain intact. Assume that the economic and political and financial world, as we've known it for millennia, remains intact. Expect prices to spike and then fall back. So what are you as an investor going to do to capitalize your gains in that spike? And what are you going to do to prepare for that? And are you going to sit there and watch the prices rise and then fall back? Say, boy, I was rich. Or are you going to do something to capitalize those gains? Now, in 1979, I was relatively new to the Precious Metals Research Group. I was 24 years old. And the man of the moment was George Cleaver. He was a gold mining analyst at Merrill Lynch. And I latched onto him, and he gave me a lot of free advice. And in August of 1979, the gold price touched $300 for the first time. George and I were having lunch, and he said, what do you think about this? And I said, it's very interesting. He said, how high do you think the gold price is going to go? I said, I think it could be $500 by April of 1980. And he laughed and he said, you stupid little kid, you don't know anything about gold. I don't think it can get to $500 by April. But I said to him, we both agreed that the price was spiking higher. The question was, how high would it go? I said to George, you've been in this business at that point probably for well over a decade, maybe 20 years already. And he was the eminence gris in the gold mining and analytical market. I said, I assume at some point the price spikes. Everybody sells their gold. Everybody sells their gold mining shares and they go away. And he laughed. He said, no, that's not how the market works. The price will spike and people say, gee, I was right and I'm wealthy. And then the price will fall back and they will not have sold a single share or a single ounce. Now, he actually was not right, because Jim Sinclair, for one, had said probably 8 years earlier that he thought the price could go to $850 an ounce. And when the price got to over $800 for less than a day, he sold. And people thought that he was being a heretic selling at $850. He said, this was my target. I reached my target. So I thought, because I was this naive kid new to the gold world and silver world, that investors would capitalize on their profits and take their gains and say that was good. No, they didn't. Well, some of them did. In January of 1980, the gold price spiked up to $850 for a little bit. The next day saw what was, until a couple years ago, the biggest one-day move in gold prices in history. It was like $140 or $160, and it was downward. The gold price settled below $700 the next day. And it also, and when it got to $850, George Cleaver called me and he said, Jeff, $850. You had said $500. Boy, what a fool you were. So in April, when the price had gone back to $500, I called up George and I said, I told you $500 by April. I didn't tell you which direction it would be coming from. Cute little anecdote. The important thing is the extent to which some investors took their profits when the price got to $600, $700, $850, and a lot of others just wrote it down. So what if CPM Group is right? We have said that we thought that 2023 could be relatively quiet for gold and silver. We'll see prices rising from where they were in 2022, but we think that prices will be relatively sideways moving in this year, but that we think that there is a bigger spike coming in gold and silver prices to record gold prices and to near record, if not record, silver prices on an annual average basis and probably on a spike sometime between 2024 and 2026, followed by lower prices. So what if we're right? If we're right, or if you want to bet that the market's thinking that we might be right, 2023 should see continued stable sloughing off of gold and silver assets. We've seen this in 2022. A lot of people who thought that the price was supposed to be $50 or $100 or $750 for silver, or $4,000 or $10,000 or $20,000 for gold, were saying, I've been lied to, I've been misled, I'm getting out of here, I'm going elsewhere. You should see that continued stable liquidation of precious metals assets. So as the price goes up toward 1900, 1980, in our view, people might be taking profits. And then as the price goes down to 1780 or maybe even 1750, people will be selling. And you've seen consistent liquidation of gold ETF holdings. You've seen lower coin purchases in gold and silver in many markets. You saw something like an 18% decline in net investment demand for gold in China last year. And you saw a lot of gold being sold by companies that supplied gold to investors because no one was buying it, which backed up into the Chinese gold market. We think you'll see that continuing this year, and that gives people who are bullish and patient, it gives them great opportunities to add to their gold and silver portfolios. Bullion, equities, and related assets like forwards, futures, options, ETFs. Then, if we're right on the spike and the denouement, then in 2024, 2026, you should have opportunities to capitalize your gains, knowing that the way markets work, gold and silver prices are likely to fall back. So, what can you do? Now you can be taking advantage of any stable liquidating to add to your positions. And going forward, there are several things you can do. You can sell high and look to buy back low. A lot of investors do that, and a lot of investors do it well. We had investors in 2011 who listened to us in April of 2011 when the price went from $32 to $50, and they sold at $48, $49 an ounce at the end of April, and they bought it back at $32 like a week or two later when the price had come back off. Other investors will, and perhaps a better way, is you keep hold of your metal and your other assets, your equities or whatever, but you buy puts against them against the inevitable decline. When Bear Stearns went bankrupt and was sloughed off to JP Morgan in March of 2008, we had a lot of investors that we advised who had been buying gold. And one of them called up and said, Jeff, the price has risen over $1,000. Bear Stearns has gone bankrupt. The price is over $1,000. Do I keep buying? And our advice to him in March of 2008 was, no, stop buying. Buy puts. Buy $900 puts. Do not resume your purchases, which he had started much earlier at prices below $700 and then added to at $700 and rising. He was buying it into the bull market based on our advice. I'm proud to say, said stop buying at 1,000, buy $900 puts, and when you see the price get down to 900 or slightly below it, sell those puts back, take your profits, roughly $100 an ounce, and resume buying. He said, $900, I don't know if it's going to go back there. It did. Within like 2 months, 3 months, April, May of 2008, it was back below $900, and he resumed buying. And he sold those puts at a really nice profit. So you can sell high and look to buy back low, or you can sit up straight, learn about options, qualify for trading options, hold your metal, hold your assets, buy puts against them. If the price continues to rise, if those guys on the internet selling you, stuff are right, no. If the price continues to rise or if it stays high, you've lost the cost of those puts, but you're still long an asset that's appreciated. Or if you want to, what CPM Group likes to do with its clients is compound option strategies. And we do a variety of things like butterfly strategies and such. But you can buy a put and pay for it with a call spread. And you can hire CPM Group to help you do that if you're a qualified and eligible investor. So there are ways that an investor can capitalize on a spike in prices and stay long. And that's our advice to them. Are you going to capitalize on that spike, or are you going to watch it fall back? It's really a very interesting choice that investors have. That's all I have for now. Have a good weekend. Take care of yourself. Take care of those around you. Reach out to others. Try to find a way to help the world. I'll talk to you next week.